I'm John Barber here at the SuperReturn Conference 2013 in Berlin with Roger Holmes, who is a partner of Change Capital, a firm founded by the retail expert Luc van der Velde. Roger's had a very distinguished career beginning at McKinsey, where he was a partner responsible for the consumer and retail practice. He moved into industry to earn his stripes as a main board director at Kingfisher, and ultimately was chief executive of Marks & Spencer, one of the most high-profile corporate roles in the UK, whether retail or otherwise. So pleasure to be here, Roger, with you. Now, given that panorama of experience, it's a hot topic in the industry, public ownership versus private ownership. What are the pros and cons in your view and your experience?
Well, I've certainly had the benefit of seeing both sides by now, and I think there's no single model that you would go for. I felt it was a privilege when you've got companies of the scale of Marks & Spencer's to work with them. They're known by everyone. You've got tremendous resources, but they are super tankers, and I have to say it's been unbelievably refreshing to have made the switch across to private equity. And when you're sitting around and there's far greater simplicity amongst the stakeholders, what you're trying to achieve, and with the mid-sized businesses that we concentrate with, your ability to move relatively quickly and see results is very energizing, and you are reminded of, in a public company board, the quite heavy burden that comes all around the governance and other expectations that are increasingly a part of the time that public company boards spend.
And so you're happy to be free of audit committee, remuneration committee, etc. And where do you spend? So if that time is freed up, where do you find the highest return on effort is in spending time in the private setting?
You say the privilege is you are spending time around the table with the guys running the business. In our case, they're typically the founders of the business who brought their company successfully to a point, and you're now helping them take it up to the next level. They might have 50 to 100 million of turnover, and it's how do they grow? And obviously consumer spending generally in Europe is flat, so you need to be a niche business with something to offer, and it may be how do we grow internationally, how do we grasp the opportunities of the internet and e-commerce, and how do we keep the proposition sharp and differentiated that the entrepreneur created, and make sure it's not diluted as the business grows and develops.
So in these flat markets, but also fast-moving, treacherous markets, fashion-centric, risky, what have you done? What have you done over the last 4 or 5 years? What are your signature deals?
Well, probably it's a measure of the power of brands. Probably the brand that we're most associated with, one of our investments in the first fund was Jill Sander, that we bought from Prada and very successfully worked with and then handed on. And we've done, regardless of the perceptions of fashion, we've done successful investments both in Fund 1 and now in Fund 2. Also in the food area and in casual dining. And so always in the consumer retail space, and finding companies that are differentiated, have something distinctive, but are now finding how do we make the full benefit of that.
So let's pick up on operational challenges. Yeah. The largest threat and opportunity as a non-expert, I would guess, is e-commerce. So how do you handle that in your different portfolio companies and that threat and that opportunity?
You're right to say that's top of mind for everyone. That is having, particularly when there's low overall growth, if a lot of demand is going over to the e-commerce channel, it's either threat or opportunity. And one of the things we'll obviously be working with these mid-sized businesses is how do you launch on e-commerce? And literally in the pace of 12, 18 months, you can go from nothing to 10% of sales, configure it in the right way, and that's adding to both sales and profitability. But at the same time, you then need to rethink your store portfolio. What's the right size of stores? What number of stores do you want? You want your bigger stores to be real flagships for the brand, and it's changing the role of those stores and of the sales advisors in the stores, and can you use technology there? So I think it's not just about e-commerce and having a trading e-com website. It's what can you do to bring technology and innovation more generally into the business, both to improve the customer experience in a multi-channel way, but to improve the productivity of the companies as well.
So what are some tangible examples, say, in the fashion side and the food side of this application of technology and release of capacity and capital?
I think it's some great practical ones. If you take casual dining, we've seen and then had it applied in some of our companies, having iPad ordering for customers. And that both changes the customer experience, puts them very much in control, gives access to information, but it also improves the productivity from a staffing point of view. And so we've introduced that into a premium burger concept in Italy, and the reaction is very positive. Likewise, I think if you look within a store environment, some of the innovations that Apple did, and I think you can see people like Barber have done a great job with putting iPads in the hands of the sales team, completely changes the interaction with the sales force. If you put it just out there, customers won't touch it. Put it in the hands of a sales advisor, and it can bring technology to what they were probably doing before. But I mean, if you take premium fashioners from ours they will have great sales advisors, have their little black book with their best customers, and they ring them up each season, and that personal interaction is still key. But you put the technology in their hands, which allows them to keep track of what that customer is buying, not just in London, but what are they buying in Paris and New York and elsewhere. And if you don't have it in stock in the store when she's with you, how can you ship it? You ship it to their home in London, to somewhere else, and that just solidifies the relationship and is making the best of the technology to improve the experience.
And looking ahead, 5 years, 10 years, you mentioned the importance of still having a flagship store, physical presence to leverage the e-commerce brand. But do you think physical property has a future? If you take back your M&S, will M&S have, I don't know, if it has 600 stores today, will it have 300 physical stores in 10 years?
I think all retailers are having to rethink right from square one what is the right shape of the portfolio, and it rather depends on which sector you're in. I think you do want the customer contact, you do want the ability to communicate your brand, and technology gives you lots of opportunities to do that. So I think you will want a tight group of flagships that really allow you to express that. And then how many stores, you might have pick-up points. I mean, if you've got a convenience offer, you better make sure it's convenient to pick up. So be in railway stations, be in motorway service stations, because that's a way of making it convenient. But that fundamentally comes back to rethinking what's our proposition, what's going to make it really helpful for customers, and they will use you multiple contact points, whether they are researching you on the internet, dropping into a store on the way to work, part of a leisure experience, and you've got the benefit of rethinking that in the context of new technology and wanting to make the most of it.
We've been very generous with your time and comments. Final question, looking at the European landscape, because you invest on a pan-European basis, where are you underweighting, where are you overweighting, where do you worry about, where are you enthused about?
That's interesting. I mean, you say it is one of the benefits we feel of looking across Europe is that we can flex that. If we contrast between the first and the second fund, we cap no area we wanted to be more than 50%, but as we come into the second fund, I think it's fair to say for Southern Europe, we would only have invested in, as we have done, in brands in Italy, where there is the potential to take those businesses international. And there are some great brands in Italy which still have that potential, and so we remain excited about that market. But if it was an Italian or Spanish only domestic opportunity, we would be extremely cautious about it. Whereas, by contrast, it's no surprise that 2 out of our 5 investments are in Germany, and it's a more resilient. Some of those are international, but equally we may look at some German-only opportunities because the size and resilience of that economy is sufficient to justify an investment there alone.
Great. Thank you very much, Roger.
It's been a pleasure.